This is Jody Trana with Chapter 3, Part 2 of Business Finance. Let's review the spreadsheet that shows how the balance sheet and income statement are compiled. It starts with the trial balance that has all the accounts listed with their normal debit or credit balances. Then the different categories of accounts are allocated to the different reports. Assets, liabilities, and equity are reported on the balance sheet, and the revenue and expense categories are reported on the income statement. The balance sheet must balance, so it includes the net income or net loss from the income statement in the current year earnings account in equity. Here you can see a simple balance sheet. It is very simple, but it contains all the categories we need for review. The first thing I always do when looking at a balance sheet is to make sure that it balances. That is, that the assets equal the total liabilities and equity. I suppose it's a bit of habit, but I do like to see that it balances. You can see the accounting equation in this balance sheet. Here's how the accounting equation looks for this company. There are $177,250 worth of assets. And who owns the assets? Creditors and lenders own $56,250 of it, as we can see from the liabilities section. And stockholders and owners own $121,000 of the assets. Just a brief look at these numbers tells us that the ownership in the company is more than twice that of the debts of the company. That certainly is a healthier position than if it was just the opposite, having twice as much debt as ownership. So that's encouraging. One of the performance issues for financial managers and external analysts is how liquid the company is. Liquidity is a measurement of how easily a company could pay off its obligations. Liquidity is measured with the current ratio and the quick ratio. These ratios measure how well the current assets could pay off the current liabilities. On our balance sheet, we can see that our total current assets, are 3 times larger than the total liabilities. The total liabilities includes a notes payable number, which is a long-term liability and not a short-term liability. So just looking at the absolute numbers, we can tell that our company is very stable from a liquidity standpoint. It has more than $3 in assets for every $1 owed in liabilities. Another measurement of performance is to look at how well the assets performed. Remember that we've said assets should only be purchased to grow the company or to bring in more profits. To look at the total assets and to see how well they have performed, we look at the figure total assets compared to the net income. Remember that net income from the income statement is transferred over to the balance sheet at the end of the year. So we can find this year's net income in the current year earnings account. Just by looking at it, you can tell that Coastal Creations had a good return on their money. Think of it this way. They invested $177,250, and 12 months later, they earned $55,000 on that money. That's over a 30% return. That's the return that the S&P reports for their highest producers. People inside the company, as well as external reviewers, are often interested in the relationship between debt and equity. We know from the accounting equation that debt and equity represents who owns the company. This relationship can show a lot about a company. From the figures we show, the debt is $56,250, and the equity is $121,000. That means that we have more than $2 in equity for every $1 in debt. That's a good ratio as long as we can afford to pay the debt and shows that the owners are invested in the business. Another measurement that we often see from financial reviewers is net working capital. Net working capital is the difference between current assets and current liabilities. It shows the excess, we hope, that we have in current assets over the current obligations that we have in the current liabilities. A healthy net working capital can give a company flexibility in cash flow management and provides opportunities to take advantage of opportunities for growth.